Hello, my name is Graeme Lamb and I'm the director of Quo Vadimus Media Ltd and the writer of a number of books, including for AAT on accountancy and bookkeeping. And this is episode 4 of our video course on AAT Level 2 Introduction to Bookkeeping. And this episode is on the theme of capital and drawings. This course is for anyone who is studying or who is thinking of studying the AAT Level 2 Certificate in Bookkeeping or the AAT Level 2 Certificate in Accounting, both of which have the units Introduction to Bookkeeping, which is what this video course is all about, and also Principles of Bookkeeping Controls, which is what a subsequent video course will be all about. In this particular episode, we're going to introduce the topics of capital and drawings. I say introduce because, as with so many of the topics that we are looking at here for AAT Level 2, it's a complicated, complex topic with lots of different components. So mostly because this is an introductory course and we're just looking at the Introduction to Bookkeeping unit, we will just be looking at the very basics, certainly to start with, about what we mean about capital and drawings, and then we'll pick those things up and look at them in more detail in later episodes. But we're going to look at what are capital and drawings, and as I mentioned towards the end of the last episode, we're going to be particularly thinking about this in the context of sole traders because that's easiest. We're going to be looking at what do they mean to a business and how are they recorded. That means how would we look at them in the context of the bookkeeping of a business, which we're gradually introducing ourselves to in the first few episodes. Well, capital is a number of different things. As I've mentioned in the previous episode, there are words in accounting which have more than one meaning, and that can be quite confusing sometimes. We're looking at capital in a very particular context here today, even though it is a word which means more than one thing. And we are talking about it in terms of, in particular, the money which is put in by an owner. So, for example, when somebody starts their own business, they may put money into their business bank account in order to fund the beginnings of the business. That is an example of an owner introducing capital. And of course, an owner can put money into their business at any time in terms of introducing capital. It doesn't just have to be at the beginning, but that's one example. So capital can be increased by money being put in by an owner. It can also be increased by the business making a profit. We're not going to go into detail about that at level 2, but just to be aware that capital in a business can be increased by the business making a profit, can be decreased by the business making a loss as well. And also the value of capital can be changed by changes in value of assets and liabilities. We're going to touch on that a little bit more in the next episode, episode 5, when we look at the accounting equation, which is all about the relationship between assets, liabilities, and capital. But generally, those are the 3 key ways that certainly at level 2 we're going to think about where capital can be increased. The first is by money being put in by an owner, and we're going to see an example of that in a moment, by the business making a profit, or changes in value of assets and liabilities. Can be decreased by drawings being taken out by an owner. So we have to look at capital and drawings together, particularly in terms of sole traders. Can be decreased by, as I've already mentioned, the business making a loss, and also by changes in value of assets and liabilities. So capital can be quite a fluid thing for sole traders. You'll see when you do your level 3 studies that can be slightly more complicated when it comes to partnerships, which is why we are just looking at it in terms of sole traders here. We are thinking of sole trader as being somebody who runs their own business. They put capital in, they take drawings out. That's the context in which we are looking here. So we have an example in terms of bookkeeping, and we've already looked at so far in some of our previous episodes that asset accounts will always have a debit balance, liability accounts will always have a credit balance, capital accounts will also have a credit balance. And that's because, in a way, capital accounts are a bit like a liability account, because the capital is the value of the owner's business, which can increase or decrease through profit or loss as the owner puts money in, as the owner takes money out, as the value of assets and liabilities change, etc. So because it's the value of the owner's investment in the business, it's also, strictly speaking, money that is owed back to the owner at some point. So that's why it behaves like a liability, and so it has a credit balance. So we have a double entry transaction here. So somebody has started off their business on the 1st of January, and they've put £20,000 of their own money. So they're putting capital into the business, they're investing their own money into the business. We have a credit entry in the capital account for £20,000, and we have a debit entry in the bank account for £20,000. And again, we've already seen coding a couple of times so far. Quite often accounts which are to do with capital and other related matters are in the 3,000 range, which is why our capital account has 3,000 as its coding here. Bank account debit 20,000. So we've got movement here of money, and I touched on in the last episode about the dual effect, which I'm just introducing here. For every debit there must be a credit, for every credit there must be a debit. Every single transaction has at least two impacts. So the dual effect here, the dual impacts, is capital has increased by £20,000 on the credit side of the capital account. At the same time, the bank account and asset has increased by £20,000 on the debit side. And again, as I mentioned in later episodes, we're going to look a little bit more about why these are credits, why these are debits. But in this example, all you need to know, an owner of a business has put £20,000 of capital into the bank in order to start a business. We've got an increase of capital on the credit side. We've got an increase of the bank on the debit side as well. Drawings then are when the same person, an owner, withdraws money for personal use. So again, just remember, in the context of what we are looking at here, we are thinking about sole traders. That doesn't mean that drawings doesn't exist for partnerships or for limited companies, for example, which you do look at through your studies. Just we're thinking particularly about sole traders here, just because it's the easiest example. So money withdrawn from the business by the owners for personal use. That's what drawings is. So with drawings, owners are taking money that they are owed by the business, i.e. from their capital balance, out of the business. They are drawing it out of the business. So that money is leaving the business. So with capital, money is coming into the business from the owner to the business, whereas with drawings, money is leaving the business from the business to the owner. And the impact of drawings is that it has a reduction in capital. And we'll see a little bit more about what that means in particular when we look at the accounting equation in the next episode. So an example here, only one half of the double entry is shown here. Debit drawings. So whereas capital, whereas money coming into the business is recorded on the credit side of the capital account, drawings, money leaving the business, is recorded on the debit side of the drawings account. It is perfectly possible, by the way, within bookkeeping for there to be a capital account where money coming in is recorded on the credit side of the capital, and if the owner makes drawings, then that's recorded on the debit side of the capital account. That's perfectly possible. But the advantage of having a separate capital account and a separate drawings account is storytelling. My students always say to me that the main thing that I tend to talk about bookkeeping is that bookkeeping is telling a story. And quite often separating things into separate accounts, like it is here, money coming in on the credit side of capital, money going out on the debit side of drawings, makes it much easier to tell the story within the bookkeeping. It's just much more visible of what's going on here. So we have a debit entry in the drawings account for £2,500. What that entry there says, it says 18th of March, bank, £2,500. Not really touched on what the details says so far. But if it says bank on the debit side of drawings, what that means is we should expect to see an entry on the credit side of the bank account. So although it's not shown here, there is a credit for bank of £2,500. Again, for every debit, there's a credit. There's that dual effect. So we got in this example, the owner of a business has withdrawn £2,500 from the business for personal use. So that money has been removed from the business, perhaps, for example, from the business current account to their personal current account. Very, very common for sole traders. So as I've already talked about, a business will tend to either have a capital account and a drawings account and record each separately, which is preferred, to be honest. As I've said, it's better storytelling, or they may record both capital and drawings in the capital account. It's absolutely fine. I would just say that the first one is better. If you have, although we are talking about sole traders here, you could get into sort of partnerships and limited companies, which we've not touched on at all yet, where if you have multiple owners, which obviously you don't have in a sole trader, because that's the very definition of a sole trader is one owner, but in a partnership where you've got multiple partners, or in a limited company where you have multiple directors, etc., then it's very common to have one capital account per owner. So at level 2, you'll just see one capital account per business. But a business may have, if they have multiple owners, just so you're aware of it, one capital account per owner. So a partnership with 3 partners, for example, will have 3 capital accounts. And that will reflect the different levels of investment and profit share, etc. It makes it easier to separate what capital is owed to what partner, or what capital is owed to what director, etc., etc. But just expect at level 2, one capital account, one drawings account, and then you'll see that expanded into multiple accounts through level 3 and beyond. So that's the end of a very basic introduction into capital and drawings. As with the other things that we've looked at so far, in terms of looking at assets in episode 2, liabilities in episode 3, we are going to come back to these things again, and we're going to see them in more detail, particularly as we start to see them in the context of more bookkeeping entries, and as we start to see them in the context of the trial balance later on. We will come back to these topics. This is not the only time they're going to be talked about. You will learn more about them, but these early episodes, just very, very simple introductions to some of the basic concepts and whether they are debits and credits, etc. And that means in our next episode, episode 5, that we can start to put together the knowledge of episodes 2, 3, and 4 by looking at the accounting equation. The accounting equation puts together assets, liabilities, and capital, and starts to show us the relationship between them. So in our next episode, episode 5, we'll look at the accounting equation. We'll look at what is the accounting equation? How is it calculated? What can a business do with it? And we'll see that it's one of the most valuable tools for accountants, particularly to see the value of a business and to compare the value of a business over time, to see how successful a business is, etc., etc. Such a simple tool in many ways, but such a powerful one. And that'll be in our next episode, episode 5, the accounting equation. Please do, if you've enjoyed this particular video, if you found it helpful, please subscribe, please like, please comment, please tell your fellow students. It helps us to get these videos out there in front of more people, boosting the accounting and bookkeeping profession and the knowledge of our students. There's more information available over on our website, quovadimusmedia.co.uk. In particular, we have product pages for all of our level 2 study guides with links about what's in them and where you can buy them as well. There's links to where you can buy those books on there. And you can also find us on various online platforms. You can find us on X, you can find us on Blue Sky, on Instagram, on Facebook, on LinkedIn by searching for Quo Vadimus Media Ltd. And you can also find me personally, Graeme Lamb, on all of those platforms as well. And we look forward to seeing you in our next episode, episode 5, where we look at the accounting equation.